Welcome, and thank you for tuning into KBRA podcasts. We cover topical research discussion, industry commentary, and more. This is the second part of our conversation with Dan Daniello, co-founder of the Carlyle Group. In part 2, Bill and Dan discuss the drivers behind the growth in secondary strategies and the increasing role and impact of private credit and direct lending. Stay tuned to learn more.
So let me switch gears now, Dan. Another interesting topic in private capital these days is the recent significant growth, especially over the past 2 years, in the number of GPs launching secondary strategies. This trend has included rather aggressive buying, building, hiring, and stealing of secondaries talent and capabilities. And this isn't a new idea, but for reasons I'd love to hear your thoughts on, it seems to have gained greater popularity. What accounts for that attractiveness of the secondary strategies for GPs and their LPs for that matter?
Well, let's start with the GPs. The GPs with a secondary strategy at the GP level, and sort of the new catchword is continuation funds. And basically what that is that a typical closed-end limited partnership has, 4 years of investing and 4 years of exiting, or 5 and 5 or whatever. But in some cases, the investment hasn't been held long enough to achieve the full return. And there are some assets you just love to own forever. And so, in effect, a continuation fund, which in effect is a secondary for a GP, they can give the option of their LPs in the first fund an opportunity to roll into the second fund with the same asset, or to have their liquidity, get their liquidity. And by the way, that's at the GP level. At the LP level, they always have the option, if they're invested in a closed-end private equity fund, of selling their position into the secondary market. And why would they do that? They would do that for two reasons. One, for if they needed the liquidity, or two, if they wanted to rebalance their portfolio in some way, shape, or form. And the buyer of that secondary has a great opportunity to, or an investor in a secondary fund has a great opportunity to enjoy less of a J-curve effect. In other words, the asset is much more cured and much closer to its ultimate exit and realization than it would be if it was an originally invested asset in a closed-end private equity fund. So you can generate a little bit higher returns without the J-curve because the holding periods are much shorter between the time an LP buys a secondary and the time that secondary is exited finally. So portfolio rebalancing, strategic extension, liquidity, these are all issues that come into play when you're thinking about secondaries. And by the way, secondaries are really a very small part of the market today. I mean, when you consider, say, for example, in public markets, when you consider the annual IPO volume compared to the annual trading volume, I mean, the annual trading volume, which is a secondary when you're buying and selling stock, it just dwarfs the IPOs. And I would say the same thing right now in private equity. More and more people are coming to realize that secondaries are another way of investing that give you a little bit more flexibility and give you a different level of maturity of the asset and a better opportunity to hold it for less of a time for more of a return. But of course, with that in mind, you always have to ask yourself, the more rapid the turnover of investments, the more difficult the decision is to what do I invest in next. And so we also have opposing this secondary phenomenon. We have long dated funds where LPs just want to have their capital deployed and they're willing to accept a relatively low return so long as they can continue to have that compounding for a long time. And so there are long dated funds now that are just at the other end of the spectrum. These are all tools for managing your portfolio that have to do with time, return, and risk. And so that's sort of the way I look at secondaries. It's one of the tools that investors have to do, let's call it portfolio management.
And do you think that the expanded access to secondaries funds in retail wealth management context, does that lead to something dramatic down the road, a convergence of public and private markets, perhaps, or am I taking it too far?
Well, I would probably say you're taking just a little bit too far, because the primary difference between public and private markets is trading off some form of liquidity, some level of liquidity against some level of risk. And there are increasing evidence that public markets tend to accumulate large companies and very mature companies. Private markets tend to be more in the entrepreneurial growth phase and medium-sized business looking to go the next step. And so there is an element there of, let's call it, diversification of size and liquidity versus the non-diversification of a growing illiquid business that, notwithstanding that, needs to do things that wouldn't be readily appreciated in a public setting. That is to say, they have to look at long-term sustainability and growth from a smaller base, whereas, the public markets, they have to worry about quarterly reports. And they're more focused in some respects on quarterly earnings, whereas the private end of the market is basically looking for a long-term sustainable company where they can take it public and it becomes capable of scale and stability. And so the risk return trade-offs are a little bit different. The liquidity issues are a little bit different. And the time horizons. Everybody says they're looking long-term, but you can bet that analysts are even looking at private equity companies, alternative asset companies, are looking at what you do for the quarter versus last year. And so you try to stay away from those comparisons if you're building an asset, a company that needs capital and is a little bit lumpy in the context of that capital consumption.
Absolutely. Thank you for that. So another trend that is fascinating to watch from our perspective at KBRA as we're analyzing debt issued by investment funds is the continued evolution of private credit. It wasn't that long ago that was the headline, the new adoption of private credit strategies. And while some of the headline power may be lost, it seems the train keeps moving. The Preqin data from last quarter said that 520 funds were raising private credit strategies in the last quarter, and half of those were focused on direct lending. And that's particularly interesting. First question, big picture. Do you think that the world of private credit, particularly direct lending private credit, has managed the recent economic and pandemic crisis better than traditional lenders could have or would have? And does that bode well for the industry?
I think they have, to be quite honest with you. I mean, I think, first of all, I think private credit has become sort of institutional in the sense that it's weathered COVID very well. It has a long-term viewpoint similar to private equity. It doesn't have the kind of stipulations with respect to ratios on the balance sheet, risk-based capital, SEC requirements, et cetera, that a bank holding company would have. And so, I think it can be a lot more patient. And by the way, it can be a lot less formulaic than the bank loan business. And that is to say, it can conform to the needs, opportunities, and events that occur in a private setting that would otherwise make a smooth cash flow equivalent to a bank loan virtually impossible. The idea to have the flexibility to work with the lender in customized ways is another major advantage of private capital. And of course, as the banking industry has pulled back a bit in their lending of middle market and below, that has been sort of filled in quite nicely with private capital. I think private credit is where private equity was about 15 years ago, 10 years ago. And right now it is exploding in terms of growth. There's no question about that.
Great points, Dan. So on the flip side, some might argue that private credit strategies are helping to fuel excessive leverage in the private equity markets. The relationships between and amongst the funds is really remarkable. That's not our position. It's just something that's said out there. What are your thoughts on and response to this?
Well, my thoughts are shame on the equity that allows that to happen. Because, the bottom line is this. As an equity investor, your first and foremost challenge with regard to debt financing is that it's prudent relative to the asset. I would say the same thing about the lender. The lender is not going to take the kinds of risks that put debt in an equity risk position. And so in our observation, leverage levels, and we do, of course, most all of our deals are private, and we have had public companies and we have financed public companies, et cetera, and our principles are the same. I mean, there are no more materially high levered balance sheets on the private side than there are on the corporate side, as far as I can tell. And we're typically somewhere around 50 to 65% debt to capital, maybe sometimes 70, but that's in an asset that's really stable. So we view, the debt on the private side as being no worse or less with regard to the risk it's taking, but much more customized to the cash flows and the strategic plan of the lender, i.e., the creditor, the creditor, the company. So it's just a matter of customization and not a matter of leverage level, in my opinion.
Great point, Dan. And there's recently a trend of direct lending platforms becoming so large they can compete as an alternative to bond financing. $1 billion plus loans originated from a platform. What does this say about the future role and continued growth of private credit markets in this country and in Europe as well?
Well, I just think that there will be some form of equilibrium sought, but at this point in time, I think the private credit grows much more quickly. Of course, understand that private credit relative to the bank market worldwide is still relatively small. I mean, there's plenty of market share there to gain without putting people like JPM Chase, in trouble. But obviously, it's a growth industry, and it will be growing faster for sure. I don't know exactly where that equilibrium is going to come, but I can say that private would grow more rapidly in the, let's call it, middle market and below, and that's sort of obvious, I would think, and probably a little bit more growth oriented in the context of its risk profile than public financings, which look more towards stability and cash flow and less toward creative, high growth, expansive, entrepreneurial type situations.
Dan, I could talk to you for hours. I learn so much when we have these conversations, and there's so many other topics, but we've taken a lot of your time today and really appreciate all of your wisdom and insight. And thank you for sharing it with KBRA and our listeners.
Thank you so much, Bill. I really appreciate the opportunity. You've been a generous host. Thank you.
Thank you, Dan.
Thank you, Bill and Dan, for your insights. This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Crowbond Rating. Don't forget to access all of our ratings and research for free at kbra.com. Lastly, if you have any ideas for future podcasts or would like to share your feedback with us, please email media@kbra.com. We hope to see you next time.